Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Paul Sweeney, along with Tom Keene. Join us each day for insight from the best in economics, geopolitics, finance, and investment. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show. Weekday mornings from 7 to 10 Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And as always, on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Bob Michele joins us here. He's always focused. Bob Michele, he's the CIO and head of Global Fixed Income, Currency, and Commodities Group at J.P. Morgan Asset Management. He joins us here in our studio. We appreciate that. Bob, thanks for coming in from down here in like 48th Street down there, kind of where the J.P. Morgan folks are. They're building that new building, which is going to be awesome. I can't wait to check that out. Bob, what are you thinking about your Federal Reserve today? I'm calling it your Federal Reserve, 2 o'clock. What are we going to hear from your chairman?
Well, there's the top down and the micro. From the top down, I want them to get in and out in 2 hours and do as little to disrupt the markets. It should be a simple, easy meeting. Make it that way. Go in and say, you know what, we're still looking at stuff. Things are going pretty much in our direction. Couple mixed signals. Maybe unemployment popped up a little bit. Maybe inflation's a little stickier. Nothing's ever a smooth path. You're going to get some bumps, but we're confident where we are. See you in a few months. That would be ideal. I think Jennifer is right. Welcome, Jennifer. How nice to see you. Thank you so much. These two, honestly, we're looking right at you.
I am not Tom Keene.
I can see that. It's in the dots, right? It's in the dots. They probably have to move the dots down to 2 easings this year from 3 because inflation is looking a bit stickier. What we're interested in is that long-term median neutral dot. Is it really going to stay at 2.5%, or is that going to drift up a little bit?
I mean, okay, yes, I can see your ideal world that we get in and we get out and nobody gets hurt out of the conference after the meeting. But we're going to have to get some sort of signaling out of this man after he's through speaking. And, you know, how are we going to be fixed if he does a Bank of Japan and has no change but is still a little bit hawkish because of all the upside surprises we've had in inflation?
Well, I think he got burned on the pivot in December because the data that's come out since December has shown both an economic resilience and a little flare up in inflationary pressures. So I think he's going to be careful not to pivot again. And I think there is an opportunity to just back up and say, hey, the data will be mixed. We're confident of our policy. We're going to watch things. Nothing's carved in stone.
So I guess that kind of goes to the issue a lot of folks are having, which is, boy, the inflation, this last maybe 3% to 2% in inflation, that's going to be a little bit harder than coming from 8 or 9% down to 3%. Does he frame that as like, we're okay with that? We understand that. We're still on our path. We're okay with some of the recent data we've seen?
I think he can. There was some expectation that the start of the year, you get slightly hotter inflation prints. It happened last year and then tailed off. I think the bigger thing for them to address are the significant loosening in financial conditions indicators. The market has pretty much done a couple easings for them, and that's percolating through the system. And it's doing a lot of things. It's elevated equity prices. I know you commented that bonds were boring. They're not. They're roaring ahead. When we look at credit spreads, they've narrowed a lot. Yeah. Those are things that I'd like to see him comment on at the press.
But I guess where are the balance of risks now for the Fed in either moving too slowly or moving too quickly?
Exactly. Those are the balance of risk.
Thank you.
I think it's a really tough one because you could sit here and pretty much make any case that we're in a soft landing right now. That should continue for the year. Yet we are seeing some tightness in the labor market. We were looking at travel and leisure yesterday. It was the first day of spring at J.P. Morgan. We brought the travel and leisure analysts in from the equity and credit research teams, they were all talking about the tightness in airlines. It's not just so much the planes, but it's the shortage of pilots, of crew, of airport maintenance staff. You look at hotels, they're starting to pick up again. There's a lot of resiliency in consumer services. I think that's got to be some of their concern, is that things start to accelerate again.
Yeah, we follow, at least in this studio, we follow the cruise industry a lot because that's just a great barometer of what the consumers are. And all the cruise CEOs of the C-suite folks that we talk to, business is booming. The consumers, and it seems to be continuous spending. What do you make of the U.S. consumer here?
Yeah, I heard that the icon of the seas has a triplex that rents out for $100,000 a week on a cruise, and that was booked solid for the next 2 years. So there's money out there. I think you have to go back to now, what is it, 4 years ago, March 2020, when the CARES Act came through. And I think when we look back on it 10 years from now, we're going to realize the amount of liquidity that was unleashed into the system. And it feels like it's all sloshing around, because how can you have things like money market funds continue to go up? You're over $6 trillion. So there's a lot of money going into money market funds. The entire Treasury curve is trading below the Fed funds rate. So clearly money is going into the bond market. You look at equity prices, they continue to set new highs. You look at prices out in the consumer area, whether it's groceries or houses, those are still high and staying there. Where is all this money coming in to elevate the price of everything? That is creating a resilience on the part of the consumer. They continue to spend.
All right, Bob, so we're going to have a Fed. I guess they're not going to do a whole lot today. They're going to try to, as you mentioned, kind of just say steady as she goes. As a fixed income guy, what are you doing here? Are you just buying the 2-year and getting 4.67%? Are you going out on some credit risk? How much farther out? Because last year in the high yields, in the fixed income space, high yield was the place to be. What are you doing this year?
Yeah, it's a good question, because like many fixed income investors, we want yields to go down, but we want them to back up a bit so we can buy a bit more. Okay. We're looking to buy every backup. We do think that ultimately the Fed will be cutting rates this year. We still think that regardless of whether they dial it back in the dots to 2 expected cuts this year, we think they'll do at least 3. Inflation is still closer to 2 to 3% than it was to 7%, and we're nowhere near what they've told us their 2.5% neutral rate for the Fed funds rate is. So we expect rate cuts. That gets us to buy duration. Credit's the interesting one, because you are at the narrower end of their historic range. When we look at something like high yield, which you mentioned, we're about 325 basis points over Treasuries. We go back to previous periods. You can stay here for a long period of time. You look at the period 2004 to 2007, you traded either side of 300 basis points for most of that period. You actually got down to 241 basis points over Treasuries. So there's still a lot of room for credit to run, particularly in a soft landing. You see the same thing in investment grade corporates. They traded between 80 and 100 basis points over from 2004 to 2007. By the way, that was when we were heading barreling into the great financial crisis. Right. So there were some stresses in the system, but it just tells you when there's money out there and things look stable, it will go into credit.
You know, with things getting so frothy, especially at the lower end of the credit spectrum, are you sort of starting to have a thought that we might be witnessing the seeds of the next crisis? You know, you have things like the absence of creditor protections in high yield borrowing, for example, or very risky mortgage securities getting packaged into CLOs. I mean, you know, is that actually going to end well for us?
Well, it's surprising that it's lasted this long, because we have had a 525 basis point rate shock. and we broke the regional banking system, we thought there would have been more of a knock-on effect across credit. But when you look at the public credit markets, they actually look pretty clean. When you talk to our credit teams, the kind of issuance that they would have historically seen at this part of the cycle, they haven't seen. And we think it's because the private credit markets have grown to be so large. They're effectively absorbing the marginal borrower that would be in the public markets. If we go back to 2007, the private credit markets didn't exist. It was all about hedge funds and leverage. Today, the private credit market is about 1.7 trillion. It's actually just slightly larger than the 1.6 trillion value of the public high yield market. It's in a way acting as a form of reinsurance to the public credit markets.
Do you guys, so does JP Morgan play in that private credit business at all? I mean, that's completely separate from your world.
It's within our asset and wealth management businesses. So we do have teams that look through it. They see a lot of opportunity. They're looking at core opportunities that are between 9 and 11%. SOFR's 5 and 3/8, and credit spreads are 4 to 5%. You're getting it largely from the increase in the Fed funds rate. And then for the more marginal story borrowers, you're looking at 12 to 15%. You can't escape it. You have to realize that a new source of non-bank lending has been created since the start of the pandemic.
I tell you, in that part, like when I was at the Chase Manhattan Bank, in the media group, we lent against cash flow, no asset values. So to go to our credit committee and say we're lending against Airwaves, say, for a cellular company was crazy. But that's leverage lending to me. And that was hugely profitable. I'm surprised the banks have allowed that business to kind of go away from them in this private credit business.
I'm sure the regulators have had a have had a hand in that.
That's what Jamie Dimon would say.
But your conversation about Chase Manhattan, about making loans, you go back to the way the Fed traditionally operated. It was to lower rates, create some stimulus in the system, create more lending into the system. This sort of extension of credit, the credit multiplier, well, that's what you see in private credit now. It's an extension of credit into the system. That 1.7 trillion that's out there, regardless of how much of that's actually been tapped and lent, it's still going to businesses who are using it. They're hiring people. They're contracting for facilities, for goods and services. That's going into the economy. It's real.
When is the new JP Morgan Chase building on Park Avenue going to be open? Because I've been watching that since day one. And folks, if next time you come to the city, Park Avenue, like 48th Street, 40, whatever it is, awesome building. When's it going to be ready?
You're an alum. You should come back and have a look. August 2025, put it on your calendar. Just ping me or Diamond, J and say you were an alum. You'd like to get in.
This is what we're going to do. We're going to do, put this in the calendar for August 2025. Bloomberg Surveillance remote broadcast for the opening day of the JP Morgan
awesome. Let's
Chase.
do it.
Are they going to bring everybody back together again, hopefully, in this building? Because you guys are all over the place now.
Yeah, we're across 3 buildings. We refer to it as our Midtown campus.
Oh, okay.
Some are in better buildings than others. Some were in buildings that their glory years were about 50 years ago.
Yep.
So there's a lot of anxiousness to just move around and get to the right place sooner than later.
All right, I'm sure Jamie Dimon is driving a bus on that one as usual. Bob Michael, thanks so much for joining us. Bob Michael, he's the CIO. He's the head of Global Fixed Income, Currency, and Commodities Group. We call that FIC here in the biz at JP Morgan Asset Management. All right, let's check in with somebody who's also going to be paying attention to the Fed today. That's Dennis Lockhart. He's a former president of the Federal Reserve Bank of Atlanta. Dennis, thanks so much for joining us here. What do you expect your former colleagues at the Fed to do today? What's going to be a good day for the Fed today?
Good day would probably be not to make too much news. I think certainly will be no policy action today. I think the attention will be on the summary of economic projections, the so-called dot plot, and that could move from the December dot plot in such a way that the markets will react and public will take notice of probably fewer rate cuts would be the signal, but I'm not 100% sure that's going to happen. In Powell's press conference, I think he will stay very close to what he said in the recent testimony, and therefore he's going to be non-committal about June, and probably just repeat some of the themes that they still expect to cut rates this year, but they're not giving any indication of when that would start.
Let's go back to your comment on the dot plot, because what I think a lot of investors are going to want to know is are we going to get 2 cuts or 3 cuts? So what's going to be the key factors, do you think, that policymakers are going to have in mind when they consider either sticking with their current dots, or perhaps some people changing their tune and shifting to 2 cuts this year?
I think what's on the mind of those who might consider moving their dot to perhaps to lower, that would be 4 to 3 and 3 to 2, is the recent inflation picture with disappointing inflation reports recently. The producer price index really actually jumped. It was quite hot. And I think that just raises doubts in their minds as to whether the relentless disinflation is going to continue, or whether we're seeing a stall out of some kind, possibly even the indications of some resurgence in inflation. All of those are open questions, but they are questions on the mind of committee members, and they're going to have to think about whether they have effectively reset the clock in order to get confident that disinflation will continue.
I've heard a couple of different camps out there. One is, it's just kind of seasonal, beginning of the year, little pop-up in inflation. Don't worry about it. The trend is still downward. Where some others are saying, hey, it kind of feels like inflation's kind of reasserting itself a little bit here. How do you interpret the data?
Well, I'm very attuned to the quirkiness of the first quarter. I was on the FOMC for 10 years. Half of that time, 5 years, I think we had unusual first quarters that didn't allow you to extrapolate from the behavior of the economy in the first quarter to the rest of the year. So I think there's a reasonable chance that these recent inflation numbers are anomalies, or they are just bumps in the road. They're not necessarily indicating any change in the overall trend. And so I would, cautiously remain hopeful that the disinflation should continue as the year goes on. Also, there is some indication of the slowing of growth, which is part of the pressure that's put on prices. The Atlanta Fed's GDP now, which is measuring the first quarter, is just above 2%, or around 2%. That's down from over 3% in the fourth quarter and over 5% in the third quarter. So there does seem to be a slowing trend, and I think that will help on the inflation front as well.
How do you think Fed officials read the bigger risks now for either moving too soon or moving not quickly enough?
I think they probably, at this moment, are more concerned with moving too soon than not quickly enough. Having said that, they're certainly aware, and there has been some who have commented on recession risk. They're certainly aware that if they stay too long at these elevated levels of the policy rate, they could precipitate a slowdown, whether it would amount to a recession, but it could be an unnecessary slowdown. So they're trying to thread the needle here. They're really trying to preserve the soft landing that we're in and the employment levels that we're enjoying without, pushing the economy into recession. So I think at the moment they're probably more concerned that they could go too early.
Dennis, do you think the Fed has taken the recession risk off the table, or do you still think that's something they're really actively trying to guard against?
I think that they probably view it as a contingency with lower than 50% probability. So it's not necessarily something that they can see developing in the data, but it's always possible that they make a policy error, they stay too long, and then they have to play catch up, and the economy ends up in a cycle that's trending more weakly than they really intended. That's always a possibility of that.
All right, Dennis, thank you so much for joining us. We really appreciate getting some of your time this morning. Dennis Lockhart, he's a former president of the Federal Reserve Bank of Atlanta. We appreciate getting some of his time. Frances Donald, chief economist, Manulife Investment Management. She joins us here in our Bloomberg Interactive Brokers studio. Frances, it's Fed Day today, so let's just start right there. What do you expect to hear from the U.S. Federal Reserve today?
I don't know.
Okay.
And I think that's the most interesting part of this is that we're going into this, and I think many Fed watchers are trying to figure out what is the Fed going to care about. And one of the big problems that we're having is there is a whole bunch of data pointing towards softness of inflation, resilient economy, and then there's other data that says, actually, there's weakness in the labor market and inflation is too sticky. So you can actually construct whatever narrative you want. What's really important from the Fed today is to find out which data points they are watching. Do they care about financial conditions again? They used to, then they didn't. Do they care about core CPI? Do they care about PCE ex shelter? Give us the data points that you're watching so that we have an idea of what your decision-making function is. Right now, it's not clear.
But I've been a reporter at many a central bank press conference, and then whenever we ask what indicator you're watching, we always get told we watch everything, which is not helpful. So, what would you like to hear from them? What would you want them to be their pick? Because we always hear them focus on core or super core inflation, but what else?
Well, that's why Fed watchers get paid what we do, which is that we're supposed to parse the details and not necessarily list directly. Now, one of the clues that we can use without them actually saying, here are the 3 data points we're looking at, is what does that dot plot do? Because if we move from 3 cuts this year to 2, that's going to signal to us that they are putting a little bit more weight on some of that sticky inflation. And yet I'm going to be watching a lot of the conversation around 2025 and 2026 because we're spending an awful lot of time talking about, are they going to cut in June? Are they going to cut in September? That, for most of my clients, for our funds, is far less relevant than what the next 18 months of cuts looks like. Are we in a 1995 soft landing with 3 or 4 cuts? Or are we going to be in something that resembles much more of a traditional easing cycle, which is hundreds of basis points? That story is the core for most investors, not whether they start in June or September, not if it's 2 or 3 cuts.
Do you think the U.S. Federal Reserve is afraid of a recession, or have they kind of taken that off the table, do you think?
Yeah, that in my preview that I wrote for our internal clients this week.
I'm looking at now.
That's
right now.
The genesis of the question
Yes.
is exactly that, which is, are they still trying to land the soft landing story, or are they afraid of a recession? And this is really core because you might remember at Jackson Hole in 2022, we were told we are not afraid of a recession. We may need a recession to bring inflation back down. And then we started to hear a different story, which is we're going to try to prevent a recession with that December Fed pivot party. So I want to know from them, and they're not going to tell us directly, but we're going to parse the words. I want to know from them, are they still trying to engineer that soft landing, or are they okay if they enter recession territory? One of the challenges here is that it's very difficult, just like it's hard to have a soft landing, to have a small and kind of baby recession. And what we need to be aware of, and this is, I think, what would keep me up at night if I were a Fed official, is that things don't tend to break calmly when they break. Mm-hmm. Recessions don't occur in straight lines. They are non-linear. Take a look at the unemployment rates or jobless claims. When they break hard and fast. That's what I'm most concerned about. And I'll be looking for signs from the Fed. Are they also worried about that risk?
If I could, let's move a little bit more internationally because we've got a lot of central bank decisions this week. And one thing that we've been noticing in Bloomberg News is how synchronized central banks have started to become. What do you make of that in terms of what that should mean for the outlook for U.S. policy?
To me, it suggests that, well, a lot of the factors that were driving inflation were global in nature. So inflation globally is pretty much coming down, especially for developed markets, about the same amount of time. So we have June circled for every major central bank. The ECB, the Bank of England's pretty close, the Fed, the Bank of Canada, they're all pretty much going to be ready to go in June. And that's when we will know definitively that the worst of inflation is behind us. But to me, it calls into question how much of the decline we've seen in inflation so far has been due to Fed or central bank hiking, and how much of it really was the supply side factors from COVID. And I know it's still not popular to say it, but to me, what you're really getting at is that this inflation, a huge part of it was transitory. It was made not worse by hiking, certainly globally. And now those transitory factors are coming undone and central banks can ease off. And the best example is, yes, the Bank of Japan just hiked, but their inflation came down with just about everyone else with no hikes at all. So there's much more of a global narrative around inflation than I think many of these individual countries, when you're looking just domestically, have admitted so far. I think when we look back in history, we're going to see this was a global story. We are still in a post-COVID economy, and that is really much more important than these individual meetings that are happening with each central bank.
How about the U.S. labor market? It's been tremendously resilient, although we did see the unemployment rate kick up to, I guess, 3.9%. How do you think the Fed views the labor market in their calculus?
Well, it depends what bias they want to have. So we made a list of all the job market indicators that were saying there was weakening happening, and then others that said jobs were doing just fine. And they were about equal and a page long at the same time. So for every data point that said things are just fine, in fact, the labor market's still strong, like jobless claims, we have other data like rehiring activity or job cuts that suggests the opposite. So this is why I say it's going to be really important to get a sense from the Fed as to what they're watching, because this really is a situation where you can make up an argument for either side of the narrative. My personal take is that when you start to see some indicators fail, the other ones are likely behind it. And as I said before, they don't tend to move smoothly. So I still believe that recession risks are underpriced in this market. And we need to be really cognizant of the risk that if a recession were to materialize, it's about 2 years after the first rate hike. That's today.
It's such an interesting idea because, I'm looking at the Fed calendar. If you type FOMC, you can see the upcoming meetings. So if they were to go in June, that's not at all a foregone conclusion. You're looking at July and September. Those are the only meetings left before the U.S. presidential election. So what I start to think about then is what kinds of political pressure the Fed might come under, and something that might push them into either staying their hand or moving more quickly. Because if, as you say, recessionary pressures are going to start picking up, they're going to have to start kicking it up with the rate cuts. So how do you read the political environment in terms of how that's going to dictate what the Fed does?
Well, the Fed will tell us this is a nonsense thing. We're completely independent. It's unrelated. But here's the challenge with the Fed and central banks and being a central bank watcher. They are people and humans too. So we have to assume that perhaps they have some sort of even subconscious bias that's coming into play. But at the end of the day, recessions and economies are giant ships. And if the election is coming up in just a few short meetings, whether the Fed cuts in June or July or September is probably not going to save this economy from a recession. If there's a recession happening this year, it is a foregone conclusion. If it's not happening, then this time truly was different.
All right, Frances, thank you so much for joining us. Really appreciate it. Frances Donald, she's the chief economist at Manulife Investment Management, joining us live here in our Bloomberg Interactive Broker Studio. Your daily look at the front pages around the world. Lisa, Mateo, lots of cool stuff to talk about. Where do you want to start here with some of the newspapers?
All right, well, starting with Bloomberg, they're saying that women's household work, it could be added to U.S. CPI consumption survey. Here's the reason why.
It's not already?
No.
Okay.
Here's the reason. Exactly. So this is a report contracted by the Bureau of Labor Statistics that found that 80% of household services that are crucial to spending living standards, we're talking about childcare, even do-it-yourself home repairs, they are provided by women. Okay, so the agency wants a consumer price index to reflect that work, and then it relies on this consumer expenditure survey to get that. So yes, it could be added into that.
I mean, I guess the labor statistics got there in the end. This is decades that we've known.
Exactly.
So, I mean, I would think this would have a big, dollar amount impact on this, index.
For sure. Yes, definitely. So we'll see. It could happen. All right.
All right. We're not very happy in the U.S. Is that the thing?
No, we're not. And it's very sad. Okay. There's a poll out there. It's the Gallup World Poll for the World Happiness Report 2024. There is such a thing. Okay. The reason that the U.S. has dropped down is because of younger Americans. 30 years and younger, they're reporting that decline in their living standards. So they're not happy. So that's pulling it down. So Americans, we fell to 23rd place.
Really?
We were 15th a year ago. It's the first time we fell out of the top 20 since about 2012 when this poll started coming out. So that's what they're saying. It's the younger generation. They're not happy. The living standards are tough. They did give a couple points about how you can become happier if you're interested. You can strengthen your relationships. You can volunteer, get outside more, exercise. So,
yeah, I don't.
But it's the younger generation.
What about Netflix binging? Is that something that's going to make me happier?
If that's what makes you happy, then go for it, because you can help us pull up this poll. But
so it's the younger folks.
It's the younger folks.
I can see it, though, because the mortgage rates are so high. It's so hard to save up for your deposit. The inflation pressures are squeezing you. And then student debt. But then also just insecurity in the job market. Lots of gig economy work, part-time contracts.
But I mean, we're in full employment. I'm like, all the Sweeney offspring are employed, that are employable.
They're the rare breed.
So that's like, I figure like I got my job is done there. I don't know.
Well, they're saying too, the younger generation, they say they're disconnected too from in person. They're more in social media. They're more in their phones than the older generation who's around we're used to talking with people, and that's how we grew up.
Yep. Interesting
So
point.
that's a big difference there.
All
right. Bloomberg big take story. We're talking about Shohei Ohtani. Okay, he's playing right now. The Dodgers open the season. The Padres, they're in South Korea, and this Bloomberg big take really looks into, can he become global sensation, which, I mean, most likely the answer is yes. But, I mean, new sponsors, a lot of them coming from Asia. This, of course, game helping out. The crowds at Dodger spring training facility, 3 or 4 times the normal size. I saw that.
Wow.
It's crazy. It's crazy. Resale ticket prices for Dodgers home games risen more than 10%. I mean, this guy is huge, and you know why. I mean, he dominates as a hitter and a pitcher, which is a rare thing since, Babe Ruth?
Exactly. And I guess, there's when he was a free agent, there was talk of maybe coming to an East Coast team, whether it's the Yankees or, the Red Sox or something like that, which would have been big because we don't see him as much here on the East Coast as obviously he's been on the West Coast. But boy, it makes a ton of sense for Major League Baseball and trying to grow the game in Asia. And starting the season in South Korea, what a great move by Major League Baseball,
and what's interesting, you mentioned South Korea too. The New York Times had something similar. They said how Ohtani, he's from Japan, and then you have South Korean baseball fans. So it's kind of putting that peace in between South Korea and Japan.
A lot of enmity, I guess, between Japan and Korea, dating back a long time, including World War II, some of the treatment there. So, but it seems like the Koreans are embracing Japanese Shohei Ohtani, which is great for both countries, great for the game. So, more power to him. And you're in the number 2 market in the U.S. in L.A. and boy, that's a good thing.
No kidding. All right, our last story. This is Business Insider.
I didn't know this was the thing.
This is the thing. So billionaires, they have their thing. Like Steve Jobs, it was the black turtleneck, right? You had Mark Zuckerberg always had that casual T-shirt. Like they all had their look and their thing. NVIDIA CEO Jensen Huang, you notice it's the black leather jacket. So Business Insider, they did the research and they looked into this and they said he's worn at least 6 different jackets of black leather jackets in recent years. So apparently this is his thing. His wife and his daughter dress him. That's what he said. So that's why he has the cool look. Of course, the women behind him pushing him into the fashion sense. His latest look came from Tom Ford's spring collection. Nice. Did you know it retails that jacket for $8,990?
That's a Matt Miller jacket. Okay, so let's speak of Matt Miller. He has more jackets than Jensen Huang. And Matt Miller has his custom made, from all over the world. They pick out the horse or the cow or whatever it is. It's just crazy. So people are into these jackets. It's not just Jensen Huang.
No, it's Jensen Huang, but it's also that whole concept behind it of it gives them less to worry about. They just know they're going to plop on a leather jacket and call it a day.
Do you know what that reminds me of? There was an interview that Vanity Fair did with Obama, and he's like, I got the blue suits and I got the gray suits, and that is what I am wearing.
Right. And that's what Steve Jobs always said. He said, it takes the thinking out. I have other things to think about. Wardrobe is the last thing I need to think about.
I'm looking at Rich Go, one of my favorite functions on the Bloomberg terminal. Jensen Huang, he is ranked 20th in terms of the world's richest people with a net worth of $78.8 billion. So that number in and of itself is impressive. What I like is the change year to date. So he's gained $34.8 billion just this year. So that's pretty solid.
That's pretty solid. I mean, and with NVIDIA just being so hot, we're going to see more fluctuation there.
Yeah, so interesting there. So, all right, Lisa, Mateo, thank you so much. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, geopolitics, finance, and investment. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show. Weekday mornings from 7 to 10 Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And as always, on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.